Imagine waking up one morning and finding out that your home is suddenly worth half its price. Banks are collapsing. Stock markets are in free fall. People are losing jobs, houses, hope. This wasn't a natural disaster. It was the 2008 financial crisis, the biggest economic meltdown since 1929. But here's the twist. The warning signs were there, clear, loud, and ignored. Today, you and I will break down the 3 massive red flags that predicted the crash, and how these same signs can help us avoid the next one. The early 2000s felt unstoppable. Stocks were rising. Homes were rising. Confidence was rising. People believed a dangerous lie. Housing prices never fall. This belief created an illusion of safety. Banks lent money easily. Borrowers took on loans they couldn't afford. Wall Street packaged these risky loans into billion-dollar products. On the surface, everything looked safe. Underneath, a bomb was ticking. Now let's break down warning sign number 1. Too much easy money. For the first time ever, banks started giving out what became known as ninja loans. That stood for no income, no job, no assets. Yes, you could actually get a mortgage with no proof of anything. Why would banks do this? Because they truly believed housing prices would rise forever. So, even if you failed to pay, they thought, we can always sell the house for more money later. This created a perfect storm. Borrowers who couldn't really afford homes, banks chasing profit over safety, and investors buying up bundles of these risky mortgages. The housing market was inflated like a giant balloon. Everyone was making money until they weren't. This was the first major red flag. Money was too easy, and risk was being completely ignored. Every bubble in history starts just like this. That leads us to warning sign number 2. Housing prices detached from reality. From the year 2000 to 2006, U.S. home prices basically doubled. This wasn't because of real demand. It wasn't because salaries were rising at the same pace. And it wasn't because people suddenly needed more houses. No, the price surge was driven by pure speculation. Cheap loans, investors flipping houses for a quick profit, and banks pushing mortgages on anyone, anywhere. When the price of an asset rises way faster than income, faster than population growth, and faster than logic, you are not in a healthy market. You are in a bubble. By 2006, an average American family needed to spend 40% of their income just to pay their mortgage. That number should never really exceed 25%. People weren't buying homes to live in. They were buying dreams funded entirely by debt. The second red flag was crystal clear. Prices went up while the fundamentals went down. A crash was becoming unavoidable. And now for warning. Sign number 3. Wall Street built a house of cards. This is the most complicated part, but I'll explain it simply. Banks took all those risky mortgages, the ones given to people with shaky finances, and bundled thousands of them together. They then sold these bundles to investors as safe products. These were called mortgage-backed securities, or collateralized debt obligations. To make them seem even safer, ratings agencies stamped them with a AAA rating, the highest possible, even though the loans inside were extremely risky. Imagine wrapping rotten fruit in shiny packaging and selling it as premium quality. That's exactly what was happening. Then, insurance companies like AIG created something called credit default swaps, which was a kind of insurance that assumed these products would never fail. But when homeowners inevitably started defaulting on their loans, the entire structure collapsed. It was a chain reaction. People stopped paying their mortgages. The mortgage bundles lost all their value. Banks lost billions of dollars. Investors panicked. Credit froze. The markets crashed. Millions lost their jobs. The third red flag was that the financial system became too complex, too leveraged, and way too fragile. One small spark, and the whole system exploded. In 2008, the bomb went off. Lehman Brothers collapsed. AIG needed a massive government bailout. Global markets crashed. Millions of people lost their homes. The world plunged into a deep recession. What triggered it? It wasn't one sudden event. It wasn't a surprise. It was the combined weight of those 3 warning signs we just talked about. Easy money, unrealistic home prices, and a fragile financial system. When you ignore clear warning signs, disaster becomes inevitable. And here's the part nobody likes to talk about. These warning signs didn't disappear. They show up again and again throughout financial history. Bubbles repeat. Human behavior repeats. Greed repeats. So the real lesson of 2008 is simple. Watch the signs. Read the data. Don't just follow the crowd. And always remember this rule. When money is easy and people start saying this time is different, that's when the danger is highest. If you want more videos like this, breaking down bubbles, crashes, and economic cycles, hit that subscribe button. Join the community, and let's navigate the financial world together. Stay informed, stay sharp, and I'll see you in the next one.